Awesome. Well, moving on to our next topic, something that we've been talking about for the last pretty much since we started this podcast was basically the meeting in March of the Fed. It's finally happening. It's actually happening kind of as we have this discussion. For our viewers and listeners, we film HGI on Tuesdays, and they're meeting right now, and what they decide won't be released until tomorrow. But we have a pretty good outlook of what's anticipated, the hike, combined with factors like inflation, the ongoing conflict in Eastern Europe, and supply chain issues that, like you've already discussed. How do all these factor into the current meeting, and what do you expect the Fed's going to be doing?
A long-awaited March Fed meeting. Finally here, right? By the time viewers listen to this, the meeting will have adjourned. They will have released a statement. Powell will have had a press conference, and the markets will have reacted. And I can guarantee you the trading is going to be, you're going to see choppy. And then when Powell comes up, you're either going to see a boom, big jump higher, or boom, big drop lower. That's just how the Fed meetings are these days. That's just going to happen. Tomorrow's volatility is going to be insane, considering all the volatility we've had coming into that meeting. So what do we expect? I mean, that's a loaded question. There was a consensus belief on my team that we were going to get a rip the Band-Aid off moment with the Fed in March. We thought that they were going to just hike rates. The market was going to accept that. The Band-Aid's going to ripped off, and we're just going to go forward. I still think that's possible, but the reality is that this whole war in Europe has really conflicted this era, made the situation very confusing. Very confusing for investors, for the Fed, for policymakers, for everybody. It's very confusing. What do they do? Because what we're looking at right now is we're looking at a stagflationary economy. We have low growth, stag, and high inflation. The Fed has a choice to either support or help out on the stag part, help out the growth, or help out on the inflation part, help fight inflation. And they made it pretty clear that their job is going to be to attack the inflation part at the expense of the stag. Now, that's the right choice to make because unemployment is super low. The jobs market looks strong. The U.S. economy looks strong enough to withstand rate hikes, a few rate hikes. So they're making the right call to fight inflation. But the pace at which they do it and how the U.S. economy responds to that and how the war in Europe progresses is far more important than what they do tomorrow. Okay? So what they do tomorrow is they're going to hike 25 bips. Okay. They're going to forecast more hikes coming down the pike in 2022, and the market's going to react to that. And that market reaction is not going to matter, really. Because what's going to matter is as they continue to hike rates over the next several meetings, how the U.S. economy responds to that, how the war in Europe progresses, and how inflation trends over the next few months as we're already into, but as the readings start to reflect a wartime period. That's what matters. So the war essentially made the rip the Band-Aid off situation be like a very gradual, like kind of like we're peeling it off slowly and slowly and checking the wound and seeing how it's doing. And I think when we peel it off and look at the wound, I don't think it's going to be that bad. Okay. I think it's like, we're okay. Let's take this Band-Aid off and get back to normal. And normal is a great environment for growth investors, for tech investors, because when you think about the trading action that's kind of happened in 2022, it's almost like somebody hit the rewind button on the human clock, like on the societal clock. Like throughout the 2000s and 2010s, we were in this world where tech stocks were working because they were growing, they were promoting the future, where software stocks were working, where digital stocks were working, where crypto was working. All these things that were the future and pushing society forward were working and working and working. And in 2022, we decided to hit the pause button and then rewind the clock so that everything that is about the future has stopped working, everything that worked over the past 20 years, and the things that didn't work throughout the 2010s, oil and gas, gold, like these dinosaur industries are making a comeback. Do not be fooled by this. Last week I said oil is a sucker's rally. Say it again. It's a sucker's rally. This is dinosaurs grasping for their last breath before they die. Those industries are dead. Don't let anybody tell you otherwise. They are dead. Solar will replace them. Wind will replace them. Electric vehicles will replace them. Hydrogen will replace them. Software is going to replace all of these archaic industries. Do not get fooled by a 3-month, 6-month, 12-month, even a 2-year blip in the history, in the course, and the trajectory of societal progress. We're still going this way. We're not going to go backwards. So continue to bet on the things that are going to drive us forward. And those things will work once we get back to a normal operating environment. Once you get back to a normal macroeconomic environment. We haven't been in that for a long time. We had COVID. We had the after effects of COVID. Now we have a war in Europe. We haven't been in a normal operating environment since 2019, really. But I have very strong faith and conviction in this idea that we're going to get back to a normal operating environment by late 2022, 2023, that it's only a matter of time before we get back to a normal operating environment. In that normal operating environment, the things that can grow revenues and earnings the fastest, which are the things that are driving society forward, that represent the future of society, are going to be the stocks that are going to win big. And all this noise you're seeing right now is really just that noise. Don't give much credence to it besides that. And to that extent, what the Fed does tomorrow, because that was the whole question here. They're going to hike 25 bips. Market's going to react, and the reaction's not really going to matter all that much in our investment thesis. When you're investing in a multi-year time horizon, what they do tomorrow is not really terribly important. It's how things are going to trend over the next several months, and we'll continue to watch those trends, and that'll impact how our stocks perform. But tomorrow, market's making a big stink about it, but it's probably going to go down in history as a moment that doesn't matter.
So kind of just to expand just a little bit on your Band-Aid analogy, because you initially thought it was going to be a quick rip. It's obviously going to be a little bit of a slower peel the Band-Aid off. You initially thought it was going to be 3 rate hikes over the course of 2022. There's talk that it's looking to be a little bit more like 6. Is this a more realistic analysis prior to your 3 rate hike analysis? And if so, does it, to your point, does it even really matter if it's 3 or 6 in the long run?
So our base case initially coming into 2022 was 3 to 4 rate hikes for the year. That was before the war. The war has aggravated the inflation situation. I think the market shifted to 6 or 7. We still think 7's a bit of an overshoot. 5 or 6 sounds pretty realistic. But the market's pretty much already priced for that, right? Like the 2-year treasury yield's up to 1 point. I lost it. I think it's like 1.8% now. Like at 1.8%, we're basically braced for 5 or 6 rate hikes. So the yield curve is kind of already adjusted to this idea that the Fed's going to hike 5 or 6 times. On that basis, we don't think yields really go that much higher than where they currently are throughout 2022. So the question, does 3 rate hikes, 6 rate hikes matter? The real question is, what will help markets? What will help markets is if they go anything less than 6 or 7. Because 6 or 7 is where the market's at right now. That's where the yield curve is basically pricing the Fed to be by the end of the year. If they end the year anything less than that, at 5, at 4, then stocks are going to have significant upside potential from current levels. If they end the year above that at 8 or 9, then stocks are going to have downside from here. But the reality is that at 6 or 7, there's a much larger probability that they surprise to the downside of that on 3, 4, or 5, as opposed to them surprising on the upside of that at 8 or 9. Because at 8 or 9, you're at that point calling for multiple 50 basis point hikes, which is pretty unprecedented and something that I highly doubt this ultra dovish Fed, led by this ultra dovish leader in Jay Powell, will do, especially as the yield curve is getting ultra flat, especially as the U.S. economy is showing signs of slowing, and especially given the exceptionally hazy economic outlook due to the war in Europe. So I think net, the upside surprise is probably going to come in the form of the Fed hiking less than where the market is today, which is 7 rate hikes. And from that perspective, that's what matters to us, as opposed to the actual number of times they go. do they go less or more than what's expected? And we significantly believe they're going to go less than that, and therefore are pretty constructive on stocks at current levels, and especially constructive on long duration assets whose valuations have been chopped because of these rate hike fears.